Tesla has had a huge decline over the past couple weeks, really since the start of the year. Now, I'm still very bullish on Tesla, and I think we are about to get onto a big run here moving forward, so long as we can avoid one big risk. Now, in order to talk about what that one big risk is and why I'm so bullish on Tesla, I need to work you through how I'm thinking about this. So let's take a step back to the week that was. Okay, everything that we have gone through so far this week and really this month and the kind of gyrations that we're seeing in the market. So, first of all, let's review how the top stocks in the stock market, the most volatile, highly tradable ones, have been doing so far year to date. So, if we look at Palantir is down 23% year to date. Microsoft is down 17%. Tesla is down 8.59%. Amazon 8.8%, Meta is up a slight 0.2%, Google is up 3.15%, and S&P 500 is up 1.27%. So that means Palantir, Microsoft, Tesla, Amazon are all lagging the S&P 500. Meta is lagging it as well, but at least they're positive, and Google is the only one that's outperforming the S&P 500 so far. So why are these companies down right now? I mean, these are the Mag 7 companies. These are the companies that everyone has been looking for. They're the leaders. They're the ones that have the AI breakthroughs. They're the ones that are innovating. But why are they the ones right now kind of pulling the market down? Well, there's a lot of different reasons why this could be happening, but I'm going to tell you kind of my point of view right now. So we're kind of in a weird space with the market. All right, you've got a handful of people, Wall Street analysts, they kind of have this whole impression of, well, is there an AI bubble? They think there is an AI bubble. Their point of view is, where's the revenue? Where's the profits? We've been promised all these amazing profits from AI, but where are they? Well, that's a fair question, but maybe it's not a fair timeline to be asking those questions. So when Wall Street has those questions, they start to maybe not discount, but they start to get worried that companies like Google, Amazon, Meta are spending so much on capital expenditures, essentially the money that they have generated from their other business, their other profitable businesses. They're taking that cash and they're reinvesting it into these big bets that, well, Wall Street's kind of like, well, where is the profit going to come from? Because we're not seeing it yet. And you're going to dump more money into that. So when I talk about Capex, what are we actually talking about? Why is Wall Street actually kind of freaking out? Well, let's look at what was estimated by Wall Street and what the reality is that these Mag 7 big tech companies are going to be spending and what they're forecasting. So let's start with Palantir. Palantir, they estimated about 50 million. Okay, that's not a lot. And they guided towards 50 million. So they are actually kind of looking decent if you think a lot of CapEx is bad. Now we jump into Microsoft. This was the first one that we start to really see like, oh, these companies are starting to spend. Microsoft was estimated by the market that they were going to spend about 98 billion in capital expenditures this year. Instead, they came out and said that they're going to do 145 billion. All right, that's huge. Tesla came out and market thought it was going to be about 11 billion. Instead, they doubled it up to 20 billion. Again, keep in mind, Tesla only has about 40 billion in cash. All right. Now they don't have a lot of debt and all that. So, that's good, but that's essentially half of all their cash that they're committing to spend in 2026 on infrastructure, on capital expenditures. Amazon is probably the biggest so far. They were expected to do about 147 billion, and they dropped the mic this past week saying that they're going to do $200 billion. Meta, 110 was expected. They guided towards 135. Google, 115. They guide towards 175 to 185. So this is where we are right now. These big tech companies are saying, hey, we're going all in. We are investing huge into this space. Wall Street, not happy about it. Wall Street, they're sitting back and saying, we don't see profits. We don't see the ROI on all this capital expenditures. We want to see return on invested capital. And they're not seeing it yet. They're not happy. So here we are. We have this AI bubble that Wall Street and a lot of people are getting scared of, saying is going to happen. Yet at the same time, we're sitting there and seeing Anthropic come out with these different, call it plugins, different software layers that kind of mimic what some of these SaaS companies are doing. Right? These past week, what was the big scare was Anthropic starting to creep into LegalZoom space. And this is creating a fear for all the SaaS companies. Everyone's saying all these SaaS companies are dead because all these AI companies are going to essentially eat SaaS companies. So it's kind of funny, though. You might be thinking, well, I thought that we didn't know where the profits are coming and there's the AI bubble. Yet now you're telling me there isn't an AI bubble and they're going to eat up all the SaaS companies. So wouldn't that be where the profits come? Well, you're kind of seeing the juxtaposition here, right? We're speaking on both sides of our mouth. Both things can't be true. It's one or the other. Either we're in an AI bubble and it's all fugazi, however you say it, or we are not in a bubble and there really is something happening here. Now, then we also have big companies increasing their capital expenditures. And to me, that's the biggest signal that we need to see. All right. When we see companies like Amazon, Microsoft, Google, Meta, Tesla investing, not just investing, increasing by large percentages the amount of capex they're spending, I take that as signal, not what Wall Street wants. You see, Wall Street is thinking from a quarter to quarter, maybe at most 12-month window. Maybe for the most extreme Wall Street people out there, they're looking 18 months. But these other companies, Amazon's known for being a long-term thinker. Google's known for that. Elon and Tesla and SpaceX, they're historically known for thinking about way down the road, right? Painting this picture and not thinking or making decisions based on quarters. Companies that do that are the Fords, the GMs, maybe even Apple, right? Companies that are kind of just trying to keep up with the status quo, trying to keep the shareholders happy enough, generate enough profit to not get yelled at by investors, but they're not the companies that are going to revolutionize. They are just trying to keep up with the times, and they're not really doing a good job, in my opinion. So we have this weird place because Wall Street is pissed off at all these Mag 7 companies and they're punishing them for this CapEx spend. But we even hear Andy Jassy from Amazon saying that they're monetizing everything they can bring on as fast as they can bring it on. So demand's not the problem. You even had Elon on the last earnings call talking about the bottleneck right now is high bandwidth memory, okay? HBMs. Before the bottleneck was NVIDIA with their GPUs. Now, this is kind of what I'm seeing that's happening. All right. We are moving wider and wider. Let me put my coffee down here. So we're moving wider and wider. First of all, we had the GPUs, right? The GPUs are think about them as like more advanced CPUs, okay? And again, I think by now everyone understands what a GPU is. The GPUs were the bottleneck. And NVIDIA essentially has a monopoly on this space, all right? They have the best chips. They're the ones everyone wants. They have a monopoly. But now there's been so much demand for the GPUs that also increases demand for high bandwidth memory. Now, if you don't know, GPUs need this type of memory, okay? A CPU needs memory as well, right? We call them DIMMs. So the equivalent of these DIMMs for a CPU would be these HBMs, high bandwidth memory, for the GPUs. You have like 3 real companies. 2 of them are in South Korea. One's United States called Micron. And they're kind of all that there is. And right now, they are all tapped out. They're trying to bring on as much infrastructure as they can, as fast as they can, but it takes a long time to build this. And on top of that, if you look at the efficiency or the yields that they get from producing these memory chips, it's not that great. So this is the next bottleneck. And we're starting to see the profits go from not just NVIDIA to now it's these memory companies. So you're seeing it start to work down the line. All right. We're also seeing the cloud companies, the big cloud companies like Meta, Google, Microsoft, Amazon, they're all investing heavily right now. Why? Well, because where do you think all this work's being done? Right? It's just the next step down the line. So the hardware layer tends to always be the first place where we see any crazy revolution happen. Even with Tesla, if you think about it, the hardware layer is what? The EVs. So once you have that, what's the next part that eventually takes you to that next leg up? It's the software layer on top of it. That's what FSD is. And that's where you're going to start to really see the impact of all these LLMs, all these agents, all that start to unfold. But the problem is Wall Street is on the wrong timetable. And to me, this is where the advance can come for all of us, right? As long as we understand what's going on. Now, even then, the problem with Wall Street is they're not seeing that there is a return on invested capital right now. There is. They just don't know how to find it or how to measure it. I'll give you an example. Right now, everyone right now listening, you all are using AI. You are all using Grok or ChatGPT or Claude, some flavor of an LLM you're using, and you are insanely more productive now. You are doing more, getting more out there than you ever have, right? That's productivity. That is really difficult to measure. And so when we have, say, 100 people working for a company and all of them had output of, say, 100, whatever the metric is, just say it's 100. But now, instead of those 100 people creating 100 of output, now it's 1,000. That's huge. It didn't cost the company another 900 people to get to that 1,000. It only took that same 100 to scale that up. That's productivity. That's more efficient. So that's what's happening. And all these SaaS companies, literally every company right now on their back end are utilizing agents, LLMs, they're automating faster, they're iterating with their product teams for roadmaps to get more things out, more software out, more products out for their end users. And it's a virtuous cycle. If product teams can design and clearly contextualize what they're trying to do and what they're trying to achieve to the developers, it saves time and entropy from the process of building. And if the builders can build even faster because they have tools like Cloud Code and agents, everything becomes a virtuous cycle. That's very difficult to measure, especially for Wall Street. Now, Wall Street also doesn't necessarily see this right now because companies aren't just going to throw all this out there. We are on the brink of a whole new paradigm, or we're living through it. We're not even on the brink. We're actually going through it, where we have this whole new way to build software, and we have to rethink everything. How do we QA test it? How do we build out security for it? How do we ensure that when we're building with it, we're not pulling just random bad libraries from the internet, right? How do we make sure that we safeguard and give proper permissions? How do we regulate against what type of answers is outputting to make sure it's client first? How do we ensure that there's no personal identifiable information going out there? How do we, all this stuff has to be rethought in the world of AI and LLMs. And that's what companies are going through right now. They are rebuilding from the ground up, rethinking their products. This is why I don't think SaaS companies are going to go away. Will there be SaaS companies that get disrupted? Yeah, sure, of course. The same way you could say Google search will get disrupted, right? Because I don't need to go to X amount of links anymore when I can just get the answer and get a nuanced explanation of my question. Instead, it's a much more virtuous and substantive answer that I get when I search. Well, that's what you're going to have with all these companies. They're going to rethink how they express their software for their end users. I think you're going to see much better products out there. But I don't think you're going to see a company like Anthropic or OpenAI come out and deliver such high, good visibility or good solutions, good results, just because they're an LLM provider. In fact, I've been saying this for a long time. I believe the LLM providers are commoditized. I think that they are not going to stand the test of time. I know everyone thinks I'm wrong about this, but you're starting to see the cracks in OpenAI, and I think you will eventually see it in Anthropic. I think these companies will eventually have to be bought up by others to stay alive, really. And the main reason for that is, how are you going to compete? How do you compete against a Meta who has an entire business stream that is highly profitable, and they can take that capital to invest into what they're doing and building out their AI stack? Same with Google, right? Same with Amazon, same with Microsoft, same with Tesla. This is the problem with an Anthropic and an OpenAI. Yes, they were the first movers. And yes, they're the ones that understood what was actually in the original white paper of attention's all you need. But here's the truth. I think they're going to go by the wayside. So, what does this mean? Okay. Well, right now, everyone's looking for the clear, obvious ROI when it comes to all these AI, LLM claims out there. And I just got done explaining productivity to you. But there's another place where it's very obvious where the ROI C is being achieved, and that's ads. Just look at Meta and look at Google, look at Amazon. These companies are able to match ads with end users in a much better way. They're able to help individuals create campaigns and stories much easier, right? So you're building ads faster, you're building ads more cost effective, and then you can take those and direct them in a way more organic, natural, and specific way. This is creating a more efficient and a higher return on that investment of that ad. Therefore, more people invest in ads. And guess what? For companies like Meta, Amazon, Google, it lowers their costs as well because they can turn out even faster. And so that's why we're seeing a lot of these companies start to print even more and more profits. Just look at Meta again, right? Meta did a really good on their last earnings. So those are the two places right now that we're seeing it, but Wall Street struggles to quantify that: productivity and ads. But what's next? Next, to me, it's very, very clear. It's autonomy. It's beyond clear. In the next days, weeks, months, we're going to see more and more autonomy, especially coming from Tesla. In fact, before I even started recording this, I just got off of X, and there's somebody sitting there saying, we see driverless Tesla robotaxis, so the Model Ys, all over us right now. They're just everywhere now. And this person just drives and just films, and there it is. This is going to become more and more pervasive. I think gone are the days of us hearing Elon give a certain timeline and then it never happens. I think those days are behind us. I think they are going to move quickly now. They gave us on the earnings report, the earnings call, again, not a big fan of, but the report was fantastic. They laid out the next cities, they said when they were going to happen, and we have a good roadmap of what to expect. So I think in the coming months, you're going to start to see this. And I believe that this will result in Tesla having a sizable move in the stock. Now, what does that mean? I really don't know. I just think that we're going to see all time highs sooner than later because of this. Now, why would that be? You always hear people sit there and say, well, I don't think that Tesla is going to actually move as far as the stock price goes until we start to see revenue and profits come in or shown on the balance sheet. Disagree with this whole point of view because one, we've already been seeing it, right? We essentially almost broke 500 and we haven't seen the revenue, we haven't seen the profits, right? Okay, so that sure isn't proof of anything that if we don't see it, we can't do it. All right. So I think we can break 500. I think we can get to all time highs. But the other reason is because this will be the easiest way for Wall Street, for analysts, for the general public to be able to quantify, figure out a model, see, touch, and really experience how AI is changing the world. It'll be the first time that Wall Street, in a very simple way, can calculate what the potential profits will be for Tesla. When it comes to productivity and ads, that's kind of messy, right? Like that's kind of difficult to quantify. It's really hard to measure. You know what's easy to measure? Oh, they've got 1,000 robo taxis. Oh, okay, they charge $1 per mile. Okay, their costs are 30 cents and they keep the rest of the 70 cents. Like this is very easy math to figure out. So very high margins, very high high ability to scale. And this is literally right in, no pun intended, Tesla's wheelhouse when it comes to manufacturing, the whole vertical integration. So I think that's the next step. I really think autonomy is the next part of this puzzle. But as I mentioned, we do have one big risk to this story. And that big risk is the market. All right. We have Fed market risk. Right now, we have Trueflation saying that we have dropped. We have dropped inflation from 0.99% down to 0.86%. Mind you, The Fed right now believes that inflation is currently sitting around 2.8 to 3%. All right. Now, why should we listen to Trueflation over CPR and BLS? Well, let's actually backtrack a little bit. Let's think about the Fed and what we know about them before we go into that. The Fed has historically been late. All right. They screwed up when it came to the Great Depression, right? They essentially created the Great Depression because they were trying to stop people from doing risky investments in the stock market. And so what they do, they increase rates like crazy, and that kind of crashed the market. In the 80s, we saw something similar where they couldn't get a handle on inflation, and we had to have Volcker come in and essentially give chemotherapy to the markets. Then again, in the dot-com bubble, right? What actually happened there? Well, we started raising rates again, and everything fell out. Now, I'm not saying that in those periods there wasn't a lot of speculation going on, a lot of margin, a lot of, bad decisions, but the Fed chose to inject itself where potentially they should have just backed off, in my opinion. '08, we saw a very similar thing. All right. Once again, the Fed starts raising rates. They do it when it's too late. They don't see what's happening. We have issues with Standards and Poor's and all the credit agencies, all this bad debt, right? We see all this stuff happening, but once again, the Fed is asleep at the wheel. We get to COVID. Once again, we're going through COVID. We see that inflation is rising and rising and rising. Even when we are sitting there at 7, 8% on inflation, the Fed continues to pump the market with liquidity for another 3 months. All right. And what do they have to do because they're late? They have to jack up rates like crazy, sending shockwaves, not just to the United States market, but to the entire world. Right? This is the history of the Fed. Too late. This isn't just Jerome Powell. This is the Fed in general. The Fed is known for being late and for really lagging on data. Now, let's get back to Trueflation. Lagging on data. Let me give you an example here. All right. When it comes to the BLS, all right, the BLS collects data on approximately 80,000 items through manual surveys and phone calls. That's right. They do manual surveys and they pick up the phone and call. For example, housing, they call about 8,000 people and they ask them, hey, people who own houses, mind you, what do you think your house would rent for right now? Okay, got it. Well, that's what I'm going to say the increase in rent is for CPI. And they only call about 8,000 people. All right. Compare this, and that's for housing. Let's go back. They look at 80,000 items, okay? Meanwhile, Trueflation, they look across 15 million items and they do it in real time. Does the BLS and CPI do in real time? No. They take about 30 days before you get the updated information and only over 80,000 items. So Trueflation is over 15 million items. They do it in real time. They use digital methods and they work with companies like Zillow and Walmart and Nielsen, right? The BLS, they're just an archaic system. Slow, archaic. They're literally using phones and doing surveys. This is what we're dealing with. And so while Trueflation is sitting here saying that we are now at 0.86% inflation, the Fed believes we're at 2.8 to 3% on inflation. Now, you might wonder, why is it so much higher for the CPI and the BLS? Well, one of the reasons is because they have a over-index on housing. So where Trueflation only does about 23% weighting of its index on housing, the BLS and the CPI do about 34% of a weighting. This is a big difference. Let me explain how big of a difference this is. If Trueflation were to use the same weighting with their numbers, their real-time numbers, inflation would be at 0.49%. This is the risk that we have right now in the market. Because right now we're on the verge, we already are in a deflation state. And we have a very restrictive economy, which makes sense when you're trying to slow the economy down and fight it. But it doesn't make sense whenever we have deflation. Deflation is worse than inflation. Let's be very clear about that. If a city, if a country, if anything stops growing, it begins to die and decay. And that's what happens with deflation. It's not just about price of goods coming down, all right? It's the cycle that it creates. So let me give you an example. Let's say that people are just fearful out there, okay? And they think that there's inflation when really we're in a deflationary state. People start to pull back. It's harder to take loans out because rates are still high. Businesses invest less, people buy less. When people buy less, that means that companies produce less as well because there's not as much demand. So they have to reduce supply. When companies reduce supply, what happens? Well, companies don't hire as much. They start to lay off people. And when companies start to lay off people and not hire as much, guess what happens? People pull money out of savings, out of stocks, out of crypto so that they can sustain their lives. This becomes a very negative virtuous cycle. And that's the risk we have right now for Tesla. No matter what Tesla does with autonomy, what happens over the next days, weeks, and months, it will not be able to supersede an economy that's tail spilling into deflation. Now, the Fed, again, they're digging their heels in. They don't think that we have gotten down to the Fed's 2% mandate, which, by the way, is an arbitrary number that started in like 2010. All right. It's not like there's a real reason other than they just want to keep the economy growing, which that does make sense. But right now, we are seeing job losses. We just saw the Challenger report come out. It was a record amount of job announced cuts, losses, layoffs since 2009. Record amount since 2009, okay, for January. This is a big deal. Now, to be completely clear, the Challenger report isn't exactly the jobs number. All right. The Challenger report is reported jobs from companies or announced layoffs, job cuts, et cetera, from companies. So don't confuse that with the labor numbers that we'll get on Wednesday, right? Normally we would have gotten them on Friday, but we had a mini government shutdown, which we're probably gonna have another one soon here. But therefore, that labor number has been delayed till Wednesday. But either way, it's probably not going to be great. Now, to be fair and to be nuanced here, the Challenger report maybe had a little bias. All right. Most of that had something to do with Amazon. Amazon laid off about 16,000 people about a week and a half ago. And then on top of that, Amazon ended a lot of their working relationship with UPS, which led UPS to essentially laying off or not hiring about another 20 something thousand people. So half of all of it was somehow UPS Amazon related. You put that aside though, it's a trend that we're seeing. We're seeing that we're having less and less job openings. We're seeing less and less hiring. This can become a really big problem. The Fed has two mandates: low unemployment, low inflation. Right now, we are seeing that inflation is extremely low. It's very deflationary, at least if you believe trueflation. And we're seeing that unemployment is pretty low and potentially going to get worse, right? And when I mean worse, I mean like ticking up to becoming high. Right now, we're about 4.5, I believe, maybe 4.4. It's pretty low. It's good, but it's trending the wrong way. We have seen it just tick up and up and up until I believe last month. But again, the data right now, it's fuzzy. And again, it's all coming from the BLS, which is just not a great source of truth. Their data, their methods are archaic and they're behind the times. So if we can get past this, if we can get the Fed to realize what's happening, if we can see, sad as it is, unemployment go up a little bit and inflation numbers to show that they're closer to what trueflation is saying versus what the Fed is saying, we might get more rate cuts. Warsh, the new Fed chairman that's going to come in, he has historically been a little more hawkish, wants essentially the Fed to kind of stay a little more hands off. But Trump would not have selected him if there was not an understanding or them looking at the world in the same way or what's currently happening in the same model. Warsh is kind of the same mindset of Greenspan, right? Warsh likes the idea of, hey, we can run an economy hot and have low rates. That's fine. that doesn't mean that we're going to create inflation. If we get the worst that I think we're going to get, I think all this market risk will be gone. I think that I've been saying this for a while, in the 1920s era of the 2000s. I think that we are in the roaring 20s right now. We just don't know it. It just doesn't quite feel like that because there's so much chaos and so much noise. But if you step back and just look at it, we've got self-driving cars. We have an explosion in AI tools. Productivity's through the roof. We see spaceships getting caught out of the air. I mean, we are in a very amazing time. Dow just hit 50,000. I'm very optimistic about what's going to happen here, but we need to keep an eye and be honest about what's happening right now with the Fed risk. Now, there's also other risks geopolitically, but there's nothing we can do about that. We at least can look at the data here and we can understand what might be happening next. And I think with wars coming in, it's very positive for us. So as a Tesla investor, as you're a Tesla investor, I imagine, I think we are on the right place right now in the right time. So what am I doing as far as my trades, if you're wondering? Well, I still have some covered calls on right now, but I'm starting to lighten up on them. I plan on not having a lot of cover calls on moving forward because I would rather miss out on covered call premium and making profits on it than risk missing out on a big pop from Tesla. Right now, we're down at what, like 410, something like that. In my opinion, it's not the time to be in a covered call, anyways. In my opinion, right now is the time to be accumulating, not necessarily selling covered calls. Now, at the same time, like I said, I do have some on right now that I placed before, but I would just not be putting everything on. I would not, it doesn't have to be all or nothing. Maybe if you still want to do something, put 10, 15, 20% cover calls on. That's fine. I get it. If you're still like, I just still want to make premium, that's fine. Just understand the risk that you might have to sell your shares. And that's not a bad risk. That would mean you bought low, sold high, and collected that premium. However, I want to get through, say, June, July, and I want to see what happens. I'm very bullish. I do think that this year might be a little different. Famous last words. But I think Tesla might be able to have a run that we don't have to wait until August, September, October before we see it. Now, history has shown that summer, spring, not great months for Tesla. So be cognizant of that, you know. But with that said, this is what I think right now. This is why I'm very bullish on Tesla. We got one big market risk out there at the moment. Anything could come up later on. But I also think that in general, the White House right now, they are on a mission to bring down costs. They're on a mission to tackle affordability. They've got a good Fed chairman that's going to be coming in. And I really do think that Tesla is on the precipice of truly scaling. All right. Thanks for watching. I'll talk to you guys later. Cheers.